Hi, good morning. Yes, it is a good morning for me because I'm recording this class in the morning 9:51 a.m. when market is already opened. Well, I have been teaching options from very long time and obviously trading in options also. But then when it comes to the teaching part, one thing which I have always observed that there is a missing link between the theoretical and practical aspect of it. And that's the reason I'm recording this class in the morning in the live market. Well, this is very first class of your advanced course on option where I'm going to teach you put options. Before this, I shared three videos with you which were reference videos of this course where I wanted to set the agenda of this course that where exactly you will be moving forward. What will be the roadmap of the course? What is the microstructure of this option market in India? They are equally important, but from here onwards, we will start doing the concept building. So, in that process, yes, you want to be one successful trader, but then the journey has to start from zero. And this is where your journey starts, where you will learn about put option in this very first class of module 1. But before I jump to the definition, what I want to do is I want to trade these two options in this class. Okay, so these two options, when I said two put option, so let's come to my broking account trading terminal. So I use this trading terminal. It's not an advertisement, it is a good platform. I love it and I use it, and I have a very high respect for the person who has built it also. Well, here you have some product to select. So the very first thing which I have selected is Nifty July put option. Nifty July future. We'll come to the future part also. But then the future is trading at 15,659. So 15,700, one put option I have selected and I've seen the price. Then I'll take another one, 15,600 put option. I'll place these two orders. You know what I want to do? I want to sell this one. Sold. And I want to buy this one. Why? I want to teach you for that purpose. Whatever is the outcome, that's completely fine. So what I have done is I have sold one option and then I have bought one option. Well, the product size got changed here, which I have bought is in MIS, another was in normal, but you do not have to worry about because we are going to maximum keep this trade open for another 30 minutes. By the time I'll finish the lecture, I'll close these trades. I have taken these trades only to demonstrate put option to you. There are two different aspect, operational aspect or the practical aspect when it comes to defining the put option, that how exactly they will be working. So that's why I've taken the trade. But for now, we'll just freeze these rates and do nothing as such right now. And directly, I'll come to the Excel sheet which I have prepared to explain you put option. But before I start explaining you put option, you saw here a few things. One, that there is something called future, and another is there are options. So what are this future and option? Well, in option class, I certainly should discuss about future and option. Well, before I tell you about future and option, I want to talk 2 minutes about something else which is called contract. And I'm going to create one scenario for you. Let's say you want to buy a house. This house worth 1 crore. But then you are expecting your money in another 3 months. There is a seller who want to sell the house also, but he is not in that hurry. He can also wait up to 6 months. You have 10 lakh rupees with you. You went into one contract with him where you said that, okay, Mr. XYZ, I will buy this house from you after 6 months. Let's say that is 31st of December 2022. Well, both of you agreed into one contract on one paper, notarized paper. Let's say that paper is 500 rupees worth. When I'm saying 500 rupees worth means when you are going to make the contract, maybe on 500 rupees stamp paper you are going to make this contract. Now what all things are there in this contract? There are two parties, you and Mr. XYZ. You, the buyer, he is the seller. Then there is an expiry date of this contract. Means both of you have to make sure that you're coming to the arrangement as per the agreement before 31st of December 2022. What else? There's deliverable mentioned there. What is the deliverable? You want to buy this house in Delhi. House number is this, location is this is the dimension and everything else. If you turn on locations. Right? So the deliverable is this house, expiry date is there, and then you have this term between two parties. So what do you see here? You see that there is a contract. In contract have two parties. The contract have expiry date. Contract has been written deliverables. And apart from this, you mention that you have given 10 lakh rupees to him. So the amount is also there. At what rate it will be deliverable? That will be also there. Right. So in this contract, another thing I want to add in this, which is called derivative contract. Now, what is this derivative contract? If you see this piece of paper which you bought in 500 rupees collectively, it looks like the price of the paper is 500 rupees. But think about a situation. The situation where this house price inflates to 1.5 crore rupee. Now the new price of the house is 1.5 crore rupee. The seller knows this and he says that no, I don't want to sell it to you. I will sell it to someone in 1.5 crore rupee. And that's where this paper will come handy. That's where you will go to the court and you will sue this guy and say that, see, we were in the agreement. This guy is not selling me the house in 1 crore rupee because he can sell it in 1.5 crore, 50 lakh rupees extra benefit probably he is making, but that is a loss for me. I have given him the advance. House prices could have gone lower also, but then I have given him the advance. This is going to cost me 50 lakh rupees if I go and buy from somewhere else. Now you see the price of this paper. For buyer, price of this paper suddenly become 50 lakh rupees from 500 rupees. So this contract is deriving the value from the value of that house. If that is increasing, the price of this paper will also increase. And that is what, in very common term, I can explain you the derivative contract. So futures and options both are derivative contracts where there will be one buyer, there will be a seller, there will be expiry date, there will be deliverables, and there will be underlying that what exactly is going to drive the price of which instrument. So you have two kind of derivative instruments. One is called futures and others are called options. We are here to learn options. On future, I'll write one blog for you which you can go through. Otherwise, we can have one reference video on futures also. So now I want to reverse that example to further explain you the option concept. Let's say the price of that house comes down to 75 lakh rupees. You have given him 10 lakh rupees, but then the house price now is 75 lakh rupees. You still have to give him 90 lakh rupees to take that house. Would you buy that house now? There's a very high chance you will say that I want to back off from the contract. When you want to back off from the contract, what will happen? Now this seller will have a loss. He agreed to sell at 1 crore. Now when we'll go to the market, he'll be able to sell only 1 crore, only 75 lakh, though he has taken that 10 lakh rupees advance from you. But it is still a 15 lakh rupees loss for him. And for you, it's a situation where you have to take a decision whether you want to buy this house or not. Well, as per the law of the land, I can tell you something. Especially in this house thing. As a buyer, when you deposit the 10% advance, all you can lose is that advance. When you are a buyer and your seller is backing off, you can go to the court. You can go to the court and you can ask the court to do the ruling on it, and you will get this in your favor, where even law will force the seller to sell the house even at 1 crore only, even when the price is 1.5 crore in the market. But as a buyer, you can always take to the court. I don't have money. I don't have rest of the 90 lakh rupees which I can pay. My suddenly lifestyle, my earning, everything gone. And then I don't have money, I won't pay him, I don't need my house, he can keep my 10 lakh rupees. The security which I have given to him. And that's how in real life this settlement will happen. And what do you learn from this settlement? You learn that the buyer have the right to buy the house. But seller don't have the right to forcibly sell the house to the buyer. But seller have something called obligation. He is obligated to sell it to the buyer. Now there is a difference, right? When I talk about right and obligation, and you have to understand it very clearly before you jump to the option concept. So yes, in this contract, derivative contract of the house, the buyer had the right to buy the house or not buy the house. He can give the deposit and all he will lose. Obviously loss will be still there. That 10 lakh rupees loss is still there. I'm not saying that loss is not there. That 10 lakh is still there. What he's going to buy anyway is 75 lakh rupees from the market. But overall he has made a loss, because something which he wanted to buy, that came down. But the loss is not 25 lakh, but very restricted to the margin money which he has given to him. Well, that's come the margin money concept, or the premium which he has given to him. So in this case, the margin word which I use there, or the deposit which I use there, in this case you have something called price of the option. Before I go and further explain about that contract, now let's come and understand about the put option as a contract. So see, what I have done is I have taken two trades on my account, but before that I want to explain you something very basic about put option. So before we go and start learning about put option, let me give you the basic definition which I have also written here. A put option is a contract giving owner the right but not the obligation to sell or not sell an underlying at a predetermined price with a specified time frame. This predetermined price that buyer of the put option can sell at is called the strike price. In my words, I want to tell you that put option buyer got a right to sell or not sell the underlying instrument at the strike price within the expiry date or at the time of expiry date. This is where this real life trade will differentiate the put option. One is at the time of expiry, and what happens when a put buyer is or a put seller is there in the market minute by minute, what is the difference happening in his position is what I'll show you from the live market. But at this point of time, let's understand the put option. I have taken few references. Let's say we have a put option called Nifty 22nd July 15,800 put. Yes, the similar kind of contract where you can take it also from the NSE website. How you have to go? So you go to market data, equity market, derivative market. Here you should top 20 contracts. One of the contract which I have taken is Nifty put 15,800. Right now it is not there. So what I'll do is I will take the most active put contract, which is 15,700. So let's say I have taken this contract Nifty put. Expiry date is the same expiry by time this contract will expire. After this contract will have no value. Strike price is 15,700. So this is that predetermined price which is called the strike price. So one put buyer got the right to sell Nifty at 15,700. He will sell it or not sell it is a different point. But yes, the right what he have is he can sell the seller. He can sell the seller of the put option Nifty at 15,700. I'll show you the application. But let me pick up the price first. So NSE Nifty 22nd July put 15,700. The price is 80 rupees 05 paisa. So let me put here 80 rupees 05 paisa. Well, in that example, the deliverable was house and it was one house. So if I have to say lot size, the lot size was 1 there. Here, the lot size is 75. Means this Nifty, which is the base index of NSE, got a future contract or got this index trading in the form of future. So the deliverable here is Nifty into 75. The value of Nifty into 75. If I have to tell you what is the value, then maybe the very first thing we have to find that what is the underlying. So 15,661 is where Nifty is trading. 15,000, I will change it here. Or it will be better if I change it here. 15,000 and you have 661. 15,661. I'm trying to give you the value of this contract. So 15,661 into 75, 11,74,575 worth of the value what you got the right to sell at the time of expiry. This is what the put option is. Well, in that case, the worth of the overall instrument was 1 crore, the house cost. Here, 1 Nifty worth is equal to the Nifty which is trading into 75. This is what you get the right to sell at. But what rate? 15,700 is the what I have taken, and the last price is 80 for 15,700. So I'll change it to 15,700. I use this sheet to explain options. Okay. Now 75 is the lot size, 80 is the price. So total premium which I'm going to give to the market when I am going to buy this option is 75 into 80.05, which is 6,000, approximately 6,000 rupees. So when you buy this, now what happens? When you buy, all you get is a right. How will you exercise that right? Let's create different market scenarios. So first, let's say in 2 days only Nifty goes to 15,500. What will happen? Well, if Nifty goes to 15,500 and you got a right to sell at 15,700, will you exercise the right? If you have the right to sell at 15,700, you will certainly exercise the right. In market it is available at 15,500. You can sell in 15,700. You will exercise this. And in the how much quantity? 75, which is the lot size. So what is the outcome if market goes to 15,500? Well, the outcome is 15,000 rupees is what you make because of the differential. But then you already have paid a premium. So this needs to be subtracted. This is what go behind the scene when you buy the put option. Right? But when at the time of expiry, if the closing was 15,500, this is what would have happened. If it would close at 15,000 at the time of expiry, at the closure of 22nd July trading day, well, again, 15,000 is the closing, or the 50,000 is the market price. You got a right to sell at 15,700. Mind it, I'm repeating it again and again. The price of this glass is 10 rupees in market, but I got a right to sell you at 20 rupees and you got the obligation to buy it from me. I will certainly sell it to you at 20 rupees. So similarly here, if the market price is 15,000 and you got a right to sell at 15,700, you will certainly exercise this, and what will happen? 15,700 minus 15,000 into 75 again. This gives 52,500 as the outcome, the differential. But then to get that right, let's say you already have given a premium, so you will subtract it from the premium you paid. Rest is all examples only, which I will cover very quickly here. If Nifty goes to 14,000, I will again exercise the right, sell it at 15,700 minus 14,000 into 75. Now it is much higher, and the differential, if I have to calculate this minus the premium I have paid. Only reason I have taken 3 strike prices, because I wanted to explain you that if market keep on falling, your profit keep on increasing. So yes, one definition is put option gives you the right to sell or not sell the underlying contract at a predetermined price before at the time of expiry. In another word, you can also say that you buy put option to get benefited when you are bearish about the market. When you know the underlying is going to fall, you can buy the put option, right? What if market goes up from here? So let's say market goes to 15,701 and close it here at the time of expiry. Now something which is getting sold in market at 15,701 or getting traded at 15,701, so even 1 point higher than the strike price, will I exercise the right? No. If I have to sell, I will sell in market at 15,701 and not here at 15,700. So no gains, no outcome will be there. Similarly, if it goes to 16,000, again no gain, no outcome will be there. Keep on going high, no outcome will be there, but your loss will remain the same. What? The premium which you have paid. This will become zero. There will be no outcome out of the definition of the put option, and your max loss will be the premium which you have paid. However, your profit keep on increasing on the lower side. But when? At the time of expiry. Now, before I tell you that what we are going to learn further in this class, 3 questions here for you. Who are buyers? It looks like a very sweet deal. So much of profit after investing 6,000 rupees, and maximum loss is very low. All you can lose is the premium. So who are the seller of this premium? Who are going to take these kind of risk? 1. 2. What is even the use of this put option? I mean, is it there because it looks like a lottery? This is another question you have to ponder on. Then as a trader, we are into one trading course. This is the very basic fundamental of the put option. As a trader, how will you decide that 80 rupees is the right price, whether it is to buy or sell? Yes, these all questions will get answered in your advanced course, which will be also the building block of a successful trader. Meanwhile, I have taken 2 trades. Let's see what has happened there. So I came here. Wow, we are making a profit. Where? We are making a profit in one and making a loss in another one. So the one which we sold, 15,700, let's put it there. 15,700 put. I have sold it, so minus 75. What price I had sold? Well, I had sold it 84.60. 84.60. And another one I have bought. Which one? 15,600. 15,600. At what price I have bought? I have bought at 40 rupees 55 paisa. 40 rupees 55 paisa. Now you see, something which you have sold, you will make profit if it goes down. So obviously the price has gone down from 84 to 76. 76. What will be my profit? 84 minus 76 into, since I have sold 6, so I have sold this, so the buy price minus sell price into the quantity, since I have taken in minus 75, it will give me a profit. So I sold at 84, going to buy back at 76. So lower buy, higher sell, obviously I will make a profit. In the calculation side, since I have taken minus 75 already, we'll keep the simple formula of buy price minus sell price. Here again, buy price. So the price we have to take is 35.95 is what it is going on. So 35.95, I can replicate the same formula and you see that you are making a loss. However, overall resultant is what we are making some profit there. Idea behind this live trade was only one, and that as per the definition, these are exercisable at the time of expiry, but meanwhile, options keep on trading. These are European options. So, if you see this definition of European and American, there are two type of option. One is called American option, another is European option. In American option, you can exercise the right at any point of time. But in European option, you exercise it at the time of expiry. How do you know that which is American and which is European? You see this PE? PE means put European. If it would have been CE, 15,900 CE, it is called European. If it is PA and CA, it will be put American and call American. So we in India trade European options on Nifty index, and this can be exercised only at the time of expiry, but then they trade in the market. I'm going to close this trade and end up this class for you and giving you 3 questions to keep visualizing and thinking that okay, fine, I understood the put option and what goes behind the scene, but then who are the seller of these options? What is the use of this put option? And as a trader, how will you come to know whether this is the right price or not? Because when you learn to know this, then only, all we need to learn is the pricing. Either predict it, learn it, or go as close possible to it. This is what we'll be learning in the advanced course. I hope I was able to explain you put option, which is a very simple concept for sure, but people keep getting confused, and that's why I took so much of time. And I showed you also from the live market that yes, at the time of expiry these things happen, but in between you keep on trading and you can close any point of it the way I have closed it here. While recording this lecture, I made a very minimum amount, 108 rupees 75 paise. But was there any skill involved? No, out of luck. I just bought one, sold one because I wanted to explain it to you. This is showing some money in the screen within 30 minutes of the class, I guess. But then the idea was just to tell you that yes, European options keep on getting traded in this way, where you have to buy, sell, and people keep on buying, selling, and trying to make a profit out of it. Well, next class will be on call options. So similar examples, obviously few things which you have already know will be repetitive concept, like what is the strike price, lot price, and all other things, which I will not repeat in the call option, and directly teach you that how exactly you can understand that call option application happens. But then before that, I want you to keep asking few questions from yourself, that who is selling these options, what is the use of these options, put option, and as a trader, is it possible even to find out the right price of the option, or who decide the price of the option. Let's meet in the next class, call option. But before that, don't forget to practice few questions, quizzes which I have defined for you, made for you in the put option, which further will make your concept clear. Attempt them, and then also learn that Python code which I have included within the course. You can open it. I will record a separate video for that, how to use that Python code and find out the price of the option and payoff of the option. On that note, thank you very much for attending the very first class of module 1. See you in the next class. Thank you.